Ta-da! Okay, wait. Share screen. Hold on. Okay. I'm banning anyone who doesn't say Sofi is a buy. I only got like 25 minutes. I was gonna do this some yesterday, but cover some topics. Let me pull out my itinerary. I was trying to pull up all the freaking. Okay. Okay, 1 second. Sorry, I'm short on time here. Okay, so just to cover this briefly, so SoFi got smoked this week. Let's go look at SoFi stock. If you've been following anything I've talked about this many times, I'm not calling it a victory lap. The company still exists. I wrote a community post and I keep dibs on this because apparently it's the bee's knees with YouTubers. You can see, there you go. Last 5 days, down 20%. 20%. Okay. And then I highlighted, I don't normally want to call people out, but hey, if you post stuff online, I'm not really calling the person out. I'm just sharing a post that they let's go back. So this fine fellow lost. I don't know why he has $1.8 million in SoFi stock and options. So I don't know. Named Josh Kawkak or whatever. He's a veteran, which kind of makes me sad that he's done this. Maybe he has $20 million and this is just speculation. But I suspect it's probably a lot more than that representation in his portfolio. So this is what it means when speculative stocks that are high risk, high reward, people forget the high risk part and they only think of that it could 20x and it could be the next JP Morgan Chase. And sometimes you get smacked the other way with volatility smacks both ways and you can lose $370,000. And you can say, well, it'll come back. You know, it's SoFi, it's the future. Maybe this never comes back. Okay. And maybe it gets worse and worse. And maybe this guy loses $500,000. So for all you people out there that are listening to these YouTubers and these YouTubers that do everything on your channels, all based on SoFi, all you cover is SoFi, you never really talk about the negatives of SoFi and the risks. You only talk about the positives. So I call you out and I say, shame on you, because you could ruin people's lives. And you should bear some responsibility for this. The way you flout. You can do 1 video or 2 videos on a stock. If you do 20, 30 videos in a row on a stock, you bear responsibility to the public, I think, for those opinions, because now you're being almost in a salesmanship role. And one point, I have to keep moving, but all these SoFi people, I heard 2 last night. I wanted to listen to them. That's why I didn't do this last night, because I wanted to listen to a few of these channels do live streams because they were coping with losing 20% this week. So they all did their group hug live streams. Whoa, we're not wrong, guys. This is just a temporary dip. SoFi's still the future. We're down 20%, even though they were already probably red because they bought in $12, $15 range before. So they're just like obliterated. Don't look at the 6-month chart and think, oh, it's up massively in 6 months. These people have been in the stock for a long time. They're all bag holders. All your SoFi people online are bag holders, very red bags. Okay. And they're lying unless they show proof otherwise. So they all, like, one points that I love, they were like, but the technology story of SoFi, the technology story, because they're failing as a bank. So we have to dive into the technology part of it so we can sell you that this is a real legitimate company that doesn't make money. I repeat, they don't make money. They're unprofitable. They've never made money. Okay. They had an impairment. So maybe they don't know this. On the last quarter, they had a impairment of their goodwill, which, if people don't know, when you buy another company or assets, you have goodwill, which is like the fair market value of the assets, because you can't, and then you book the rest of it gets booked separately. Pfizer, I covered kind of some of the goodwill on some of their purchases. So they had I think it was a $247 million impairment of goodwill. So surely, you should be like, well, what happened? Because that's important. That means they bought something and it's lost value. It's lost value some way. Either it wasn't growing as fast as they expected. There's something that happened that would cause an impairment that's not good. It's never good. Okay. So the goodwill stays the same if the narrative of why they bought the company maintains. And if something bad goes on, to dumb it down a bit, then they can write it off, like impair it. So goodwill impairment, $247 million impairment of goodwill on the last 10Q. This is an unprofitable company, so it's not good they're losing. They're losing money basically. So I scrolled, I'm like, okay, well, what did they impair? So we go to page 12 of their 10Q. It's right here. The impairment, okay. During the third quarter 2023, the technology segment continued to experience slower growth than expected at the time of acquisition. So all these channels that are like, Dan, it's a technology company. Galileo is growing like crazy. Blah, 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 blah. They just wrote down $247 million of value on their technology section. You fucking people, I can't believe. Shame on you, YouTubers, for pushing this stock towards susceptible retail investors and never truly saying the risks. This is the risks. They're failing, and I've covered this in other videos. Their technology growth story is failing. Okay, look, the banking part I can get to later, but the technology story of SoFi is not what they're telling you. It's not working. Okay, they're writing it down. It's not growing. I've shown in other videos. Galileo, now that they get deceptive, they will say it's growing in customer service numbers, which can be true, but it's also barely growing revenue, and it's even anemic. Actual revenue, like actual positive cash flow, is anemically growing at like 6 or 8%. This is not a growth asset for what they paid for it, and they've written it down. It's not even my opinion. It's literally the opinion of the freaking auditors, or whoever decided to impair it. Um, so it just pisses me off because let's be real, like, and you all are hugging each other because, and they all would say that this analyst is a clown that wrote that he said it's worth like 650. This guy is a successful bank analyst from everything I've seen online. This Mike from KBW, Mike Perito, he's a successful bank analyst. He literally analyzes mid cap banks for a living, and you all just throw his opinion to the side like it's nothing. He has a success rate over 50%, which is, yeah, that's good. But it's just clownish for you to pretend that his concerns are not, fair. And he really addressed. I read some of the comments. I don't have actually what he wrote. I have just the comments from other articles. But he's talking about the concerns of the anemic growth of the tech part, and he's concerned about the underwriting value and their personal loan business, which we all have been concerned about this since I've even started talking about SoFi. It's very concerning. And I've said before, you're going to get wrecked on SoFi in the blink of an eye. That's what I think. I don't think it'll be a slow deterioration. I think something bad will happen, like this is just the start of it. One analyst downgraded it and you lost almost 20% in 5 days. Like, holy shit. You people, you should be very concerned. You shouldn't be doubling down unless you understand what you're buying. It just makes me sick. I'm sick and tired of this. It's a non-profitable trash company. They can't even prove they should exist. Let's make profits. Make profits before you tell me this is the next future of banking. Jamie Dimon, you think Jamie Dimon gives one iota about this company? Let's go look at JP Morgan. Let's see if is Jamie Dimon's shaking in his boots. Oh yeah, that's right. What are they at, 52-week highs right now? I don't think Jamie Dimon gives a crap about SoFi, and you all think that he's scared. He's afraid of their growth and their platform. He doesn't care. It's a joke. So before you put 80-90% of your portfolio in SoFi, if you want to put 5%, I don't care. Because guess what? If it does 5%, fine. Because then if it does 10, 20x like you think, fair enough. You made a speculation. You did great. I'm happy for you. But if you're putting like 20% plus in your portfolio of this is a very, very speculative investment by every metric I've ever looked at in my life. Everything screams speculation here, and you're bearing a lot of risk. It's not even undervalued at even the current price. It's not a cheap stock. I don't know what you're looking at. You're looking at the wrong metrics. And I think you should assess. Don't be pissed at me that you bought a stock that dropped 20% in a week. Look at yourself, look at who is talking to you and telling you this is a great company, and just think about it. So I'll be here. My opinion, I don't see what would change. Maybe if they actually became profitable, we could actually do a fair assessment of this company. Let's wait till they become profitable. But look what happened in Palantir. If you had waited for 2 quarters of profitability, you would have missed all the downside and you would have had a good return. If you had bought on the second quarter of profitability with Palantir, you would do great right now, and I'd be happy for you. But if you believed all the hype before and you bought it when it first came out, I mean, you're breaking even, or I'm sure you're down at this point. But you know, people out there, if you see a YouTuber do 100 videos on SoFi, he's doing it because it's popular and you watch it and it gets sub count and he probably doesn't know what he's talking about with the risks, and you should call him out on it. And it's not okay that a stock goes 20% down in 5 days like this, that some guy is hyping online. This is crazy. Um, so all I can do is warn you, their business model is very concerning. They have to have this huge inflow of customers constantly to feed them capital so they can turn around and give personal loans out. I mean, the last time I looked, the student loan business was a small piece of the pie. The mortgage business was barely anything. The credit cards it was basically customer inflows, giving that money to personal loans. They were using either credit facilities to give personal loans out. So it wasn't even just customer money. They were also borrowing money to loan out to personal loans. This is nuts. You people buying this. It's not a technology company. It's a payday lender. This is what you bought. It's a payday lender. It's like, oh, I can't even get into it. So I got to keep moving. So like this is as speculative as an investment as I can even stress to you. You should not be putting more than 5% of your money into something like this because it can go wrong. And it is going wrong. And from what I understand, there's a potential that they're going to be more unprofitable and further away from profitability now. They keep saying they're towards profitability. Okay, well, why do you believe management so much when they tell you when they're going to become profitable? You should not trust management so much in this case. And your worship of what's his name, Anthony Noto, it's going to be your downfall, people. If you put like 80% of your money in this, it's not smart. You should be very speculative on this investment. There it is. They wrote down the technology friggin' assets that they bought. I mean, this is not my opinion. It's in the fucking quarterly return. So do what you want. All right. I got to keep moving. Oh, God. What have you done, Fabio? I got this stock at $10 with YouTube 1,500 and I'm stupid. Like, I think the problem is a lot of, okay. Like, I've watched like 3 or 4 different YouTubers that cover SoFi. They talk about, they look at the presentation. Basically, they just look at the presentation to investors and they regurgitate those points. That's the sales pitch of the company is giving you. They don't look under the curtain and say, let's look at what they're doing. What are they doing? The deposit money comes in from customers that come to the bank. What are they doing with that deposit money to generate a return? That's it. Figure that out. Don't worry about the technology platform because its growth is pathetic. It should be growing at 20%. It should be growing at crazy double-digit amounts if it really is what they said it is. And that's the other thing I've said before. If you look at what management tells you and then compare it to the financials, and if you can't look at the financials and look and analyze them based on management discussions, you probably shouldn't be buying individual stocks in the first place. I hate to tell you, you should not. If you believe in SoFi and you can't read financials, I mean, buy an ETF that specializes in, I don't know, fintech exposure. At least you're not at risk of single stock exposure. And if you're right with SoFi, you still could benefit. But if you, I honestly think a lot of these SoFi investor channels, they either don't understand what they're looking at or they choose to ignore it or some mix of those two things. But there's been very, very, very real concerns. And this KBW guy, he's on it. I'm sure he's on it more than I am, even because he actually specializes in this. I don't. So I've only analyzed a few banks in my life because I want to be an investor Goldman Sachs someday, which is another story. But it just sucks for me because I know people are going to get hurt. I know people out there are going to watch these channels. You want to be part of a community, so you want to be part of the future, and you think fintech is the future, and then you find a channel and it's a supportive group of SoFi people, and then you lose 20% of your investment in 1 week, and you're and they don't, and honestly, they might not know why it went down. They just start going to coat mode, and here you are, you lost 20% of your money, and you might be down already. I don't know. Maybe you bought it at $4 if you did, good for you, but very concerning. Now, the other MPW, I don't want to get. I read the short report of MPW. I looked at the 10Q. I'm not really interested in buying a hospital REIT at all. So I just kind of did as much as I could. I looked at the financials based on what the short report said. Now, the short report's out, but also MPW is suing this shorting company back. So I read part of their response. Their response is like, this is like normal. What they're doing and the claims made by the short report are like normal activities for a hospital REIT. It's kind of what they're claiming. There's nothing criminal. And they said they've been materially damaged by the short report because their credit scores went down, or credit rating went down, which caused them to have damage. So who knows? As of this video, nothing. It's in the courts. So that's when we'll actually figure it out. So all I can say is, looking at their reports, this is a very complicated company. Like, looking at it from my perspective, I'm not a REIT specialist, just I can read financials. MPW is a very complicated company. They have all these very strange transactions where they loan money to a company that's they also are renting space from, and then that company now owes them an obligation. Like, either they have back rent or they like must have declared they couldn't pay rent. So there's like these transactions where they front them a loan of some kind. I forgot the exact term for what that's called. Is it like a lease chargeback or something? So you have credit risk, right? So in one way, if it works out, then okay, the tenant doesn't get destroyed, doesn't go out of business, you keep collecting rent. But they decide, no, we're going to front them money so they pay us back. And it's like, well, okay, now you're at credit risk, because what if they don't pay you back? So now you're taking all this debt on and you're deferring revenue. And here we are. They're deferring revenue because they're not collecting some of their rent, and they loan the money to pay them rent. So these two things something has to happen. And something has happened. The stock's gotten crushed because of this. Very big concern. It's a very complicated company. There's so much shenanigans like that in their financials. I'm like, I would look at that and be like, I'm out on this. If I looked at any of that stuff for 5 minutes, I'd be like, how do you value this? So you're at a point now, if you buy this stock, if you buy MPW, you are basically buying a gambling, you're basically rolling the dice. If the company wins their lawsuit or something like that, I mean, yeah, you could probably 2-3x your investment if their claims are false. But if they're right, this thing's going towards bankruptcy with the amount of debt. I mean, you can see it in their financials. The debt's going up, and there's the deferred revenue, and something's going to come to a head with MPW. Um, Again, this is a speculative investment. This is extremely speculative. You should do, if you want to do it like SoFi, fine. This is just like SoFi to me. High risk, extremely high, like, reward could be good, but you could get, obliterated here. And I don't know, if you want to rip through their financials, it's freaking ridiculous, all the crap they're doing. So, and then also right now, the reason it went down so much this week, I think it was, MPW has been denying the short report, but now all of a sudden they're trying to collect $50 million of unpaid rent, which is kind of, if you would think logically, this is kind of confirming some of the suspicions of the short report, the fact that they're now trying to pursue back rent from one of their renters. So I don't know. You're gambling. Like, let's be real. And the people that were like, what was it? When the short report first came out, this thing got wrecked, and they were like, I remember the people were like, oh my God, well, it can't go down anymore. Look, let me pull up my fancy metrics. So let's look. January 26th. Okay. January 26th last year. Okay. What was this at? January 26th of last year. Okay, here we go. So this was like the first tranche, I think, if I remember this correctly. It kind of got blown out from like 20, and then the short report came out, and now we're down to like 12, 13. And I heard people say, well, if you do your analysis of the financials and you run, a cute calculator like Everything Money, it's very cheap compared to its competitors. Why wouldn't you buy it? It's easy return. Well, guess what? The dip kept dipping. The concerns were real concerns that some people probably bought it at this point, didn't really know what they were doing. They just saw it was cheap. So there you go. You bought a troubling asset of $13 because it dipped and it kept dipping and dipping and dipping. So, I mean, you either didn't read the short report or you took the risk and you lost on the gamble you made. So it's either one or the other. Um, so maybe it works in your favor at this point. I would run away from this thing as fast as I could. Complexity in financials like this, you should probably avoid. It make complexity of ownership, complexity of structure, or economic. Like if you don't understand what they're doing, which most people out there probably don't have a good grasp of what they're doing. These chargeback lease things and loaning renters money, and it's very weird. The short report claims like they'll go into a financial transaction about a property and like magically $50 million just disappears off the balance sheet, and it's like, where did it go? That's the short report claim, not my claim. So we'll see what happens with that. The other thing, what time is it? Okay, got 10 minutes. Any question? I don't know why you'd have a question. So just to reiterate, like if you're gonna buy MPW, I mean, you're either gambling the short report is right, or if you're buying it, you think that the short report is wrong, and they're gonna win their lawsuit, and this is all blown over, and they won't get wrecked by the debt, the pile of debt. I don't know why you would invest in something like this. I think you should pursue companies that have bright futures and not this. This is not how you should do this. But which kind of segues into the next company. It's funny that they all came together. Walgreens, MPW, just trash companies getting wrecked, and people are really hurt. And they probably maybe you don't understand why, but MP or Walgreens boots. So people are buying it because of the dividend yield. I mean, you shouldn't be buying investments for the dividend yield. You should be a dividend investor should be the same as any other investor. You're looking to buy appreciating assets, except you want something that pays a dividend that grows. So just like this company screams like stagnation and death. Like if I just run like I think we've done this before. You just run all sorts of margin and profitability metrics over long periods of time, and they're all trending down for Walgreens. It's a floundering, dying company of like a bygone era. A company that runs drugstores. Like this is not a great business to be in. I've said this before, and they had a slight bump, but then people got trapped by the dividend yield. Why did the dividend yield go up? Because the stock performance sucks, and the dividend yield they keep anemically growing the dividend while you get no share performance, which causes the dividend yield to get out of whack with the share price. This happens with other companies. Verizon, same thing. So this must be reflected of the new future amounts. But oh man, that's wrong. But I mean, like look at the growth. It's just like downtrending. Dividend growth has been downtrending for years. All right. But the dividend goes up. Well, the dividend's going up. Okay, yeah, but anemically, and the yield's going up because the share's not performing because the company is not doing well. You can look at the financials, and like recently with COVID, they went up, but this was like a floundering company. I can look at their margin performance. 5, 6 years ago, you're at 25. Now you're down to 20. Operating margin was at 5. Now you're -5. Profit margin was like 3.5. Now you're negative. Free cash flow margin was 5, 6. Now you're down to like an error. Like this is like it's a crappy business. I mean, long-term debt, is it going up? Long-term debt, they borrowed a bunch of money. I mean, are they issuing shares? Let's see. They bought a little bit of shares back, but I don't know. This is like a dying company. And if you only bought it for the yield, then you got yield trapped. This is the quintessential yield trap. It was a decaying business. The stock performance was down. They kept raising the dividend, so the yield went up, and you thought that this is a great dividend investment. And then the dividend trapped you. And then the dividend gets cut, and then the stock price collapses. This is literally what a dividend trap is. In essence, this is what you have to avoid, just like a value trap or a growth trap. Like Peloton was a growth trap, right? SoFi to me is a growth trap too. There's traps everywhere. You fall victim to these. I mean, lots of people fall victim to these, but I don't know why you bought Walgreens other than you told me that there was a 7 to 9% yield on the dividend. I fail to see what other thing you could say was exciting about a drugstore company. Like, oh, I mean, there was no other, like, now they're trying to pivot to other healthcare products, and they've been failing miserably. This was the company that failed at Theranos. I don't know if any of you even know this, that bought Walgreens. They got screwed by freaking Theranos. So they were desperately trying to find something to grow into and floundering. But again, like, why would you buy this over SCHD? Like, so that's why people gripe about SCHD, but why would you buy this over SCHD or Drogo? I have no idea. Like, I don't. There's nothing here that's of any sort of interest on growth trajectory. I mean, you can look at like a long-term, very successful company like Granger's. Okay, we have and you might think, oh, Dan, why would I buy this? The yield of the dividend. I mean, it was like 1%. It's been on a tear, but like, you have stock appreciation. The dividend is growing 7-8%. So the dividend is growing 7-8%. The yield's down. You're like, oh, that's trash. That means the company is doing well in a lot of cases because it's successful. So the dividend or the stock's appreciating, which keeps the yield down, even though they're growing the dividend. Um, so this is why, like, yield on cost is a good metric in these cases to actually assess the value of your dividends over the yield, because the yield's only, like, looking back last 12 months. If you actually look at the yield on cost, let me look at that. If I look at yield on cost, I'm pretty sure it should be fairly impressive for Granger's. Let's see. Come on, where is it? So yield on cost. So I mean, you're getting steady appreciation. You know, it's trending the right way. It should look like it should be a hill upwards, yield on cost. But I don't know. Yield traps get you. All you can do is try and do better with it, I guess. But I don't know. Walgreens is Walgreens. I'm not that impressed with CVS, but at least there's a growth story with CVS. If they can pay the debt off responsibly, not do a lot of crazy acquisitions at this point, and just monetize what they've already done, um, there's something there maybe. Way more than this. But but again, I'm like, is CVS even? I mean, CVS could be interesting this year at the valuations it is, but I think it's already started to run a bit. This is the company that's had a different strategy than Walgreens. It's not they've handled the dilemma. Both companies had the same problem. Pharmacies is a shitty business, so they're both like, what do you do? One did mergers, the other tried to, like, buy their way into solutions. Walgreens, it did terribly. But I mean, none of these have been great. 5-year performance, yeah, nothing compared to, like, compared to the market. Um, I don't know. Yeah, I mean, it's starting to come back a bit now due to valuation. I'm still not sure if he's saying it's a buy. Time is it? Okay. MPW is my worst performance on my speculation stock pick. I mean, it's okay. I mean, it just, you kind of reflect on what happened, and, so the only people that would know, like, the people that thought when it was 12, $13 after it got wrecked the first time, and they thought, well, this has to be the bottom because it's so cheap. It can't possibly get any cheaper. And you've been cut from 12 to 3 now. So those same people will now say $3 is as low as it's going to go. It can't possibly go any lower. I don't know. Maybe it becomes 30 cents or a dollar a share and gets obliterated by the markets. So other than that, what else do I want to cover? Portfolio. Okay. I mean, my there's really, like, nothing to buy right now. So I guess just been looking long-term investment wise, just index investing and ETFs. Um, I did a short on Carvana, which has worked out pretty well so far. And I should have shorted Coinbase, but never did. So I did. Now, okay, here's the funny part. I did buy Walgreens after the dividend cut, and I'm up 3% on it, I think, at this point. So I kind of wanted to make a point. I was like, you know what? We'll see what happens. I bought a small position in Walgreens. I'm kind of curious how it'll do in the next 6 months after they cut the dividend. And then from what they were saying, they're trying to strengthen the balance sheet, reinvigorate the company. Maybe they close some unprofitable stores. And at its current valuations, I could see getting like 10, 15% out of Walgreens. So at least somebody could make money on Walgreens. That's not one YouTuber could make money on Walgreens. Maybe we'll see. Wait, dividend clowns bought. Like it's, the only explanation why would you have bought it is because you looked at the dividend yield. Um, I don't know why, and the payout ratio. They looked at those two metrics and didn't tell you the complete story of the company. Um, I was why wouldn't you have just bought SCHD? Honestly, I don't understand. I didn't even look at the debt. I don't even want to know what the debt looks like for Walgreens. I can't even imagine. Yeah, bought it at 650. Oh, okay. Understand. I mean, people are wrong. Like I was wrong on BarkBox. I bought it at 9 and then I got out at like 6 something. But then luckily I did come to understand I made a mistake when there was one financials where they went off the rails with what they told us they were going to do. So I bailed. And now it's like a dollar. If I hadn't bailed, I would have lost 90% of my investment instead of taking a haircut. Um, so like you can't be so dead set on proving other people. Like I'm sure the SoFi people are just going to be pissed at me and we're going to show you. It's like, why do you need to show me? I'm just a stranger, but it's okay to move on. Maybe you cut your position down to 5% from whatever crazy percentage of your portfolio. And if it's still ruse, then you'll be part of it, but it won't destroy you. Um, I can't imagine anything that's unprofitable. I don't know how you make it more than 5% of your portfolio. Like it's unprofitable. They haven't even proven they can make money, especially a startup. They haven't even like proof of concept. Does their business model work? They can't make money so far. Like how do you invest massive amounts of money in something like that? And I'm trying to find research to because I might do a video on that talking about can you invest if you invested in unprofitable companies across broad spectrum, how would your performance be? I don't know if I'll find research on that, but um, anyways, I'm gonna work on. There is a study I want to cover. I'm trying to get a special guest to cover it. Um, I don't want to spoil it. It's a long shot if I'll get this person, but it's a research paper I find very interesting to be a good topic. I'm not gonna spoil it. It deals with long-term investing and leverage. Okay, that's the point I'll give you. Um, so I'm gonna see if I can get someone that's talked about it. It could be a fun topic. Other than that, I don't know what I'm gonna do next. Not sure. I'll have to think about it. Maybe a book review or yeah, maybe a book review. Other than that. Okay. Well, I've got to go because I'm gonna go to a brewery with my friend. So thank you. And look, if you're watching this and you want to ask me something about SoFi, like I don't know what else I'll tell you, but like it's okay to admit you were wrong or to mitigate your risk. Please just think about it this weekend. Like 20% is a big deal. Like that probably hurts some people out there. I just it's not surprising to me though. But stay safe and we will see you later. Thanks for watching and have a good one.